Hey everyone, welcome back to Corporate Decoder. Today we're diving into a company that's been juggling a few too many balls, and it looks like some might be about to drop. We're going to unpack Helius Medical Technology's latest filing, and let's just say it's not all sunshine and rainbows for this medical device company. They're facing some challenges with staying listed on the Nasdaq stock exchange, so let's find out what's going on. So the big news is that Helius Medical Technologies received a notice from Nasdaq at the end of March. This notice basically said they don't meet one of the requirements for staying on the Nasdaq stock market because their stockholders' equity is too low. Stockholders' equity is too low. Stockholders' equity in simpler terms is the value of the company if you subtract all its debts from all its assets. And theirs has dipped below the required amount. To be exact, their stockholders' equity, that is their assets minus their liabilities, fell below $2.5 million, and just to make things a little more difficult, they don't meet the alternative ways of staying in compliance either. This is kind of like a restaurant failing a health inspection. It doesn't necessarily mean they're shut down immediately, but they need to clean things up and fast. And this isn't their first run-in with Nasdaq's rules. Back in August, they were warned that their stock price was too low. The Nasdaq has a minimum price a stock has to trade at, and Helius Medical Technology's stock price had been below that minimum for a while. Think of it like a sale at a store going on for too long. Eventually, the store needs to raise prices to make money. They were given until February to get their stock price back up, but unfortunately they didn't manage to do it. And because their stockholders' equity was already low, they weren't eligible for another extension. This is like failing to get a good grade on a test and then finding out you can't retake it because you missed too many classes. The company appealed, that is, asked Nasdaq to reconsider. They had a hearing in March to try and convince Nasdaq to give them another chance. Good news! On April 1, the company received another letter from Nasdaq. Nasdaq has granted the company an extension until June 30 to fix both their stock price and their stockholders' equity issues. This means that Helius has until the end of June to get its act together and meet the requirements to stay listed on the Nasdaq. For now, their stock will continue to trade on the Nasdaq under the ticker symbol HSDT. The company says they're working to get back into compliance, meaning they're trying to get their stock price up and increase their stockholders' equity. So what does all this mean? Helius Medical Technologies is facing some real challenges. They need to convince investors that their company is worth more, which means they need to show that their products are selling well and that they have a plan for the future. Now, let's step back and take a look at the bigger picture. Helius Medical Technologies is a company that focuses on neurological or brain conditions. Their main product is a device that's designed to help people with movement disorders. The company is still relatively small, and they're trying to break into a competitive market. One of the biggest challenges for companies like Helius is getting their products approved by regulatory agencies like the FDA in the United States. These approvals can take a long time and cost a lot of money. Another challenge is convincing doctors and patients to use their products. They need to show that their device is safe and effective and that it's better than other treatments that are already available. Looking at Helius Medical Technologies, it's clear they're at a critical point. The extension from Nasdaq gives them some breathing room, but they need to use this time wisely. They need to focus on increasing their revenue, managing their expenses, and convincing investors that they have a viable business plan. If they can do that, they have a chance to turn things around. If they can't, they may face some tough decisions in the near future. I would say that the company definitely has some challenges ahead. They need to execute their plan very well in the next few months and show improvements to remain listed. Thanks for watching. If you found this breakdown helpful, please like, comment, and subscribe for more corporate deep dives.